This interview is for information only and should not be considered as investment advice or a recommendation to buy shares in the company featured. Welcome to this Stock Box interview. Welcome back, of course, to the Research Talks here from Stockbox with Alan Green and Dan Flynn. So, chaps, how have we been this week? Alan, how's your week been?
Hi, Mark. It's been a very sunny week, actually, one way or another. It's weird, isn't it? That these markets have been very muted, really. Of course, I think responding to Trump brandishing his tariffs like a weapon and the attentive uncertainty that brings. But yeah, certainly it's picked up towards the end of the week, and I'm just looking forward to the weekend, really.
Good.
How about you?
Good. Well, yes. I mean, it's been actually sort of fairly busy interview-wise for us. But yeah, you're right. There's still definitely a lack of liquidity going on in the sector. But the message from sort of CEOs is, there's can things get any worse? And funnily enough, this week, two of my friends here in the Netherlands actually messaged me and said, does Stockbox do financial advice, or what do you think we can invest in? And this was very strange. And I chatted to them, and both of them say the same thing, that they say that they don't like seeing their cash basically losing out to inflation, and they're looking for opportunities, even amongst when things are a little bit tighter for these guys over here, as I know they've been in the UK for a year or so. So, I mean, I think the opportunities are there, as we've said before. I've not put fresh money in the markets for a few years, probably 3 years, but I've started doing that back end of last year. And either I think all these companies delist and London becomes a ghost town, or indeed the money does start to come back. But as I've said numerous times, when you start to see the big funds position like Premier Miton, of course, Discovery Commodity Fund over here in the Netherlands with William Middlecope, who will actually hopefully meet next week. I'm off to Zurich to the Swiss Mining Institute, so I'm going to get a bit of a sense, I think, of how busy that is, how the appetite is amongst investors for mining companies. And I know there are quite a few fund managers there as well, so I'll hopefully get a bit of a sense next week of how confident that the capital is feeling. But yeah, opportunities are around, I think, at the moment. Valuations are pretty much on the floor. So yeah, it's buy when there's blood on the streets. I don't know what will happen generally. When everyone feels like it's tough, generally a crash doesn't happen, does it? But maybe we're in for a prolonged period of kind of slow growth. I don't know. But it seems like there's already chat around the world of, this is not good, and governments seem to be cutting already. So I can't see a huge shock event coming, but, one never knows.
Well, certainly, I had two conversations yesterday evening about companies raising money on the London market. And of course, one I'm going to discuss shortly actually is IPOing on Thursday next week. So there's still activity out there, but I think the government's got its work cut out and has to really provide incentives to get companies to list. And, unfortunately, you've got the advisors that all take their fees, which is fine as it should be, but perhaps that could be geared to performance. So perhaps they take reduced fees and then they collect fees in stock and they're rewarded on any upside. There are ways of doing it, but I just think you've got to have people at the helm that are actually cognitive of those sort of opportunities.
Yeah, indeed. Dan, how are you feeling, Dan, from this week?
Yeah, it's another interesting one, isn't it, Mark? And with you speaking of going to Zurich, of course, the one thing that has come out of the trade tariffs and all the uncertainty around the conflict with Ukraine and Russia is that gold has finally pushed through $3,000 an ounce. So I think that puts it a bit beyond all three of our predictions for where it would go by the time you made your.
Well, we've still got 3 days. It's the 17th, I think, was the Monday. So we'll see what happens. But yeah, I can't. What did I say? My prediction was 2975 or something. I think it was around that. It's
yours was 2975. I went.
There we go.
950, and Alan, I can't remember what yours was.
2995. So
yeah, 2995. So you're the closest as of now, 2993.9. So there we go.
Is there a prize, he asks?
Is there a prize? Yeah. Well done. A round of applause.
Okay. That's fine.
Yeah, we'll have to think of a prize. A beer, Alan, next time we all meet up, maybe. I don't know.
Sounds good to me.
Yeah.
Yeah,
you're at the minute you are the closest. Yeah, so it would be nice if it hit 3,000 actually for the Swiss Mining Institute. I was told that I am chairing or hosting the Garden Salon 3, which is effectively there's the main event. Then there's these garden salons, I believe, where companies will then present. And my job is to make that as engaging as possible. But I know it was a gold focused, it had more gold companies there in this one, so I'm quite happy about that because of course that's quite topical. But my description is: as chairman of Garden Salon 3, you have the distinct honour of curating an exceptional experience for our guests. This particular salon presents a unique challenge, as many tend to gravitate towards Salon 2. However, with the right approach, you can transform Garden Salon 3 into the place to be. So I've got that. That's what I've got to meet up to effectively. Attract people to come to Garden Salon 3.
Well, it sounds akin to the Cornish pavilion at Mines and Money. So it could be something.
Yeah, exactly. Yeah, exactly. So I'm looking forward to that. It's at the Dol de Grand in Zurich, which is a exceptionally nice hotel with exceptionally nice views. So there'll be definitely some pictures and some media coming out of next week. So anyway, that's what I'm doing. So that's looking forward to that. But anyway, let's crack on with discussing some companies. So Fulcrum Metals, first of all, who of course this week had that long-awaited phase 2 trial, didn't they? The phase 2 feasibility for the recovery of gold tailings with extract there. That's been long awaited. But the numbers stacking up pretty nicely there, and Ryan, me feeling pretty good about that from our interview this week. So, Dan, I know you want to talk about that. You've done some research. You want to just bring us up to speed on Fulcrum generally, then we'll play a bit of a clip from the interview this week.
Yeah, so Fulcrum's an opportunity that's flying completely under the radar at the moment, I think. The company currently has a market cap of around 4 million. And since last September, it's been trading pretty consistently below 10p with not too much volume. So this hasn't been great for existing investors. But as I'll explain, I think there's real potential for a significant re-rate here. Because what Fulcrum's doing is pretty unique among London-listed companies. And it stands to start generating some really significant revenue over not too long a time frame, which is what the company really demonstrated this week. So just stepping back for a moment, Fulcrum started out as a gold and uranium explorer focused on projects in Canada. But as markets have shifted, it's moved its focus onto nearer-term gold production from reprocessing tailings in the country. So in layman's terms, this means extracting gold from waste material left over from historic mines. It uses leaching technology. It's much cheaper and quicker than mining because the material is already out of the ground. And as a result, it can be highly profitable in the right circumstances. So Fulcrum's focusing on 2 tailings opportunities in particular called Tech Hughes and Silvernite. These are based in the historic Kirkland Lake Gold Camp, which, as you'll both know, is one of the biggest mining camps in the world. It's produced more than 47 million ounces of high-grade gold historically, based on something I was reading online. And estimates suggest the tailings at Fulcrum's projects alone contain some 205,000 ounces of gold. So that potential volume of gold in the tailings alone is great. But where Fulcrum has a real edge over any potential competitors is through its master licensing agreement with a company called Extract Processing Solutions. So the barrier to many tailings projects globally has been recovery grades, the time taken, and the ESG factor, with traditional tailings technologies relying heavily on cyanide. So all of these factors can make or break a project. But Extract, alongside its engineering partner Bechtel, has developed a breakthrough leaching technology. It's much quicker and more effective than the traditional cyanide-based ones. The recovery rates it's delivering in Canada are nearly double that of the prevailing technologies. And it doesn't use cyanide, which is a big tick in the box from an ESG perspective. So this week, Fulcrum took a massive step towards proving the economic potential that extracts technology can provide its projects. It's been completing a development plan to evaluate the efficiency of the technology at Tech Hughes for some time now. The first phase, which was a high-level gold recovery investigation, was completed last year, and it achieved gold recovery rates of up to 59%. So that was excellent. And since then, Fulcrum's been following up with phase 2, which is a conceptual study to show how these recovery rates might look from an economic perspective. Like you said up top, Mark, this is what the market's been waiting on for a while. And the results of the study came out this week, and they are looking extremely good. So I know you've got a clip with Fulcrum's CEO, Ryan Mee, about the news, Mark. So I'll let him elaborate. But just to summarize, the study found that based on an initial 2,000 tons a day of tailings reprocessing, non-optimized gold recovery rates of 59.4%, and a leach time of 6 hours at Tech Hughes, Extract's technology could provide for a 9-year operation with a $33 million pre-tax MPV. So that's already massive for a company like Fulcrum with a market cap of just £4 million. But that valuation seems all the punier when you consider that Fulcrum and Extract believe that they can increase that gold recovery rate to 74%. Based on that, the conceptual study puts the operation's pre-tax MPV at $75.5 million US dollars pre-tax. And that result in a payback period of less than 2 years. So with that, Mark, shall we let Ryan give some of his thoughts on the news?
Indeed, let's play that clip from the interview this week.
Today's news is an outstanding milestone for us, and it's one that we've all been waiting for. We're delighted at Fulcrum, same as our partners Extract. What we've really managed to do is, and this is purely just based off the leaching, the high-level leaching, is, we delivered a concept that works, and that's really important, really fuels into the next stage of work. So we're all really, really encouraged by this. And you know what this shows is it's not just scalable in terms of tonnage, but we can repeat this process amongst other sites around Canada. And really what is material about this is it really feeds into the master licensing agreement, which is what we've been waiting for as a company and no doubt investors. So now we have that technical information, which we can now, close out those discussions. Clearly, the market isn't recognising any of the value that we're building here within the company. As you said, at 33 million US NPV value compared to our current market cap of $4.5 million, doesn't make a whole lot of sense. And bearing in mind, Tech Hughes, it's one tailing site. It's one project of a portfolio of assets that we have, which is, we've got a very valuable asset portfolio. But the real key thing here is it's all about the proof of concept. Even right now, non-optimized, just based on the initial leach recovery rates of 59.4%, it shows we have an economically viable tailings project. An economically viable tailings project, which is also demonstrating how we can scale this.
Well, yeah, what do we think of that then, Dan?
Yeah, so I think a possible limitation to Fulcrum's share price today has been a bit of a lack of understanding around what it's doing. After all, it's very technical. But now that the company's released these impressive projected figures, I think it has a real opportunity to begin connecting with the market. Like Ryan said to you, Fulcrum now has proof of concept for its approach. It's demonstrated that Extract's technology has the potential to quickly generate an enormous amount of low-cost revenue with minimal environmental disruption at the right project. Now, the value of this at Tech Hughes alone would be transformational for Fulcrum's balance sheet. But I think the real blue sky opportunity here lies in the scale potential now that the economics of the technology have been established. So Tech Hughes aside, there's Fulcrum's Silverknight project, where the two companies have already delivered recoveries of up to 63% in phase 1 test work. Various tailing sites in close proximity to Tech Hughes that can be added into the mix pretty easily. And, there's tailing sites all across Canada. So while Tech Hughes is the start, it feels like Fulcrum and Extract now have the secret sauce, as it were, for recovering gold from tailings anywhere they want. And that means the sky is the limit. Before I get too ahead of myself, though, I think we probably need to think about the shorter term.
Mm-hmm.
And I think the way Fulcrum can really start to get the attention of the market over the coming months is to continue pushing through the development phases at TechUs. So the first two are complete, two more remain. The third one will focus on further optimizing recovery grades and rates in the lab to make those economics that came out this week even better. Then phase 4 will be an economic assessment designed to provide a more accurate and definitive assessment of the economic viability of the leaching operation at TechUs. So I'd like to return to Fulcrum soon, perhaps on a future episode, and talk a bit more about the Silvernight project when there's some more news there. For the time being, though, I think the key is for the company to keep building on the attractive numbers it released this week with more fine-tuning. The more it can show the profitability of its approach to gold recovery from tailings alongside extract, the more likely the market is to sit up and take notice of the long-term opportunity here, especially with strong gold prices making the value of what it's doing all the greater, like we were discussing up top.
No, I agree. I think, as you said at the start, Fulcrum is flying pretty much under the radar at the moment, and is not the value is not, or the potential is not being recognised there by the market. They were considering the gold they have and considering this new technology. And I mean, Ryan saying in previous interviews with us that Fulcrum's really more of a tech play than a mining play now, a reprocessing and technology play. And I do agree. They've obviously got to go through the rest of those stage gates there. And I know the big milestone is getting a resource estimate, JORC compliant resource estimate for what they reckon is in the ground there in tailings. And then, of course, optimizing those leach studies to get higher recoveries, and then effectively looking to sort of start a little processing operation. But yeah, the opportunity is huge for tailings. Perhaps the risk is the technology is not understood, or it's not perhaps trusted yet until maybe it is. I don't know. But then you look at other companies who, Marula Mining, for example, who we talked about last week, and again this week have announced that they've got their second revenue stream coming in with the copper sales there. And again, the market doesn't really react to that, and that's supposedly real money coming in to the bank there. So valuations are down across the board. But yeah, I think Fulcrum's a nice little slightly risky tech play, I would say. You get in now when this technology is brand new, no one really knows about it. And if it does pay off, because there's always a risk that, something won't quite work as everyone hopes. But it's a good speculative buy, I would say, at the moment. But I mean, Alan, what do you think? I know you've talked about Fulcrum with us before, having sort of seen the phase 2 news this week. Does it strengthen perhaps the risky investment opportunity for you?
Well, I think it does, Mark. Yeah, and yes, of course, I've interviewed Ryan in the past and watched Fulcrum develop their technology, and it's really important. I think as we hear on so many occasions, there are so many historic mining sites around where this technology can be employed to go through tailings, to go through existing stockpiles, and extract the minerals through this innovative technology, and it's a cash flow generator for them. But because it's a new technology, it's untried, and of course the market is not applying any premium to the opportunity yet. But I think it was a big step forward for Fulcrum this week. Mining stocks are as unloved as they ever have been in recent years, as we know. And I know I'm going to talk about two more now, but that's just where the market is. But I think any mining company that can develop a technology that generates cash flow for the business, that warrants a look. And if that cash flow is near term, then that's a game changer for Fulcrum right there.
Exactly. And of course, we've only really focused on the tailings here, but they've also got their other projects as well, haven't they? They've got their effective free carry, if you like, on the uranium project there. And then, of course, they've got their actual projects. But it's very much, the flagship is of course, the tailings opportunity.
Yeah.
So
absolutely.
I think the thing to keep an eye out there is on how they progress this year with their JORC resource.
Yeah, I think if everything they say they can do in terms of the economics actually, comes off, there's only so long that the market can sit on this, especially with gold prices rising. I mean, it just seems like an obvious opportunity at these levels.
Yeah, exactly. In the gold price, yeah, it would be very nice for them at this stage.
Mhm.
Okay, good. Well, thank you for discussion on Fulcrum there. So, Alan, Cadence Minerals, then kdnc, who seem to have gone fairly quiet recently, but bring us up to speed on what's going on with Cadence.
Well, on the one hand, you could say, Mark, from one unloved mining company to another, but as I've said on so many occasions previously, I mean, Cadence to me is bafflingly undervalued. And when you look at the asset and the size of the opportunity that they have, I'll go through the details on the Amapa iron ore project in northeastern Brazil in a second. But of course, Cadence are developing a green iron solution for the iron ore market and the iron ore industry. I mean, iron ore currently sells for about $105 per ton, but DR iron ore, which is the quality grade iron ore, sells at a premium, and the company in December last year released an upgraded pre-feasibility study for the Amapa project, and based on numbers from Platts, of course, the mining analysts, they anticipate sales for the DR grade iron ore pellets of up to $120 a ton. So that's a significant premium. There's also expected to be a significant supply shortfall in the iron ore pellet market of up to 100 million tons by 2050. So there will be a supply squeeze further down the road, which will equate to a price hike. So mines that are producing this quality DR grade iron ore pellets will be in high demand. Now, Amapa itself was a former producing mine. It was owned originally by Anglo American, and it incorporates four elements. Primarily, it incorporates the Amapa iron ore mine itself, which is the iron infrastructure, the sorting shops, the head frame, the infrastructure, and of course the shafts themselves. It also includes a railway. There's about 130 kilometers of railway which run via the airport to the wholly owned port in Santana in Brazil. And this is a port where the iron ore is shipped directly from the mine. It's loaded, the pellets are then loaded, partly loaded onto the ship, and the ship then sails out into the deep water part of the port and is then fully loaded there. So it's a two-part process. But the Amapa itself now has ore reserve estimate of 195.8 million tons. The Cadence itself currently owns 34.6% of the Amapa infrastructure. Now, if you think about that mine, the railway and the port, that entire infrastructure, to own 34.6% of that, they've invested $14.6 million. And that's an asset that was valued by Anglo American on their books in 2012 at $600 million US. So the company issued an upgraded pre-feasibility study last December. The net present value of the asset was hiked by 73% to $1.97 billion. It's set to generate annual average free cash flow of $342 million over the life of mine, which is 15 years, $9 billion in gross revenues, $4.9 billion net operating profits, and expected to be $4.6 billion free cash flow over the life of the mine. And the revision in the processing plant, as I say, it's producing this DR grade iron ore concentrate at 5.5 million tons per annum. And the upgraded PFS, whilst it was overseen by Cadence and Indosino, was worked on with the local team and the local operating company, which of course is Dev Minerals. and I hope I pronounced that correctly. So we have this asset that's moving towards DFS. That's underway at the moment, and I suspect the reason that we've had this radio silence from Cadence in over the first quarter of the year is that we're going to hear some announcements on that very shortly. But I'm not the only one that's baffled by the valuation here. Edison Research have written a number of research notes on Cadence's Mappa project, and in a note last year, April last year, and that was before the publication of this upgraded PFS, the company said that it had a value of a Mappa of 23.9 pence per share, with an overall value in the company, and I'll come to the overall value in the other two projects the company's invested in shortly, of 27.6p per share. And yet here we are at 1.68 pence. So there's a bit of a valuation gap there. The shares will trade as high as 6p on the year and as low as 1.5p. So 1.68p is the current price. But that simply reflects the fact that the markets are broken. And of course, when the markets are this low, people have no confidence in the mining sector, so they sell off their assets and force the share price down. So when the company needs to raise money, which it does, it has to raise money at these levels, and of course that then puts a floor under the share price, and it means that it's very hard for the valuation then to rise above that. So the steps really are quite straightforward for a Mappa to reach a value inflection point. We need to get to that DFS point, and that is underway. The other two assets the company owns, it has a 30% stake in Mexilit and Megalit, which are assets that form part of the Sonora Lithium project in Mexico. Now, there's little or no valuation attached to these at the moment. The remaining project is owned by Ganfeng Lithium, which is the third largest lithium producing company in the world. There's a mineral resource estimate there of 8.8 million tons of lithium carbonate, which equates to 4.9 million tons on the joint venture areas with Cadence and Ganfeng. But the ownership of these assets has been challenged by the Mexican government, and in turn, the companies have hired Clifford Chance, the international lawyers, to challenge under the UK and Mexico bilateral investment treaty. So we're hoping to hear some good news from that. The final asset is owned by Cadence. It's sold out of the European Metals Holdings now. The final asset is Evergreen Lithium, which is ASX listed EG1. Cadence owns 8.74%. It's the largest shareholder in the company. And aside from the shares, it's also entitled to a further $3.5 million Australian dollars on achievement of certain performance milestones by Evergreen. And Evergreen owns the Bino Lithium and Gold project, where exploration work, drilling, and field work have established multiple lithium carbonate pegmatites, and also extensive gold mineralization as well. And the asset, from a geological standpoint, is contiguous to Core Lithium's, which is ASX listed, also a Finniss project, which has a JORC estimate of 30.6 million tons at 1.3% lithium oxide. So there's a tremendous amount of locked up value within the Cadence asset, but the value inflection points, which I expect to hear about shortly, will be developments at Mappa. And once the DFS has been completed, then I think the company is going to really see a shift in its valuation, because green iron or green steel is going to be the way forward, and the mines that can produce and will obviously benefit, but there is expected to be a supply squeeze, and Cadence could stand to benefit from that in the future.
So what is it then? You think it's that all-important DFS that when we say this, as I said earlier, cash coming into companies means nothing, apparently. Will a DFS mean anything?
Well, it should do, Mark, and there we are. And I think we could turn the clock back to earlier years, and you'd see an event like that, and there'd be a seismic impact on the share price, and everyone would jump in. But the markets now broken, and they don't support that. But I'm happy to say, as I said, at the start, we are seeing companies able to raise money still, and we're seeing companies coming to market, which is good, and obviously at a reduced valuation. But it's the outlook is pretty challenging, to say the least.
Yeah. Well, all you can do, as I said at the start, it's going to be the same message, I think, until it changes. Just if you've got some capital to put away for a bit of a risk, then I think now is the time to start taking those positions, really.
Yeah.
It'll happen when it happens. You're right. I mean, I remember, I can't remember the name of the company. No, I can't remember the name of the company. But yeah, one of my early investments, and I remember we knew the PEA was due, the pre-economic assessment, and I positioned before that. And yeah, as soon as that PEA dropped, the share price rose 20, 30%, but it doesn't seem to happen very much these days.
Well, I think almost the opposite happens, or seems to happen nowadays. It's the old stock market adage, isn't it? It's better to travel than to arrive. You're expecting the news is going to be great, so the share price rises in anticipation. And then when it arrives, it can be good or it can be bad. But either way, in the current markets, it doesn't have the impact that you would expect, and sometimes it can go down.
Yeah, exactly. But we are seeing companies now, mining companies, having to adapt a little bit, which is a good thing, I think. You're seeing a lot more dual listings. Panther Metals only announcing this week that they want to.
Yes.
Well, they are going to dual list on the CSE because, I think there's going to be quite a big, significant kind of different change of how Panther are doing things. But they see that there's more opportunity over there to get the Canadian investors effectively on board with the story that they're telling over there. And then, like I say, scaling into small scale production, like ECR, for example. So you're seeing a lot of these mining companies having to, I think, do things a little bit differently. It's a shame that the mindset has changed away from long-term investing to very short-term. But you can see now mining companies actually adapting to that effectively, I think, and rather than, people are they don't want to say, it's 18 months away, it's 24 months away. It's like, we have to keep those things going, but what can we get in the short term? What's the low-hanging fruit to, keep our shareholders sort of happy effectively, or bring in a little bit of money to reduce the burden on having to raise capital? So we are seeing an adaptation, I think, in how these companies are working. But that's what it is. It's where it is. I mean, I don't know if, Dan, if you've got any thoughts on Cadence. I know it is a very advanced project there.
Yeah, I mean, kind of like we were saying, you don't know what's going to happen these days when these big news comes out, where there used to be that big jump. But it's hard to deny the attraction of a stock that appears undervalued with big news events on the way, even in spite of all that, is it?
Yeah, exactly.
I'll definitely be putting it on the watch list.
Yeah, definitely. It's definitely on to put on the watch list. I've always liked it. There was talk only a couple of years ago about me going out there to do a site visit. Well, that's obviously been postponed, just like Cape Town was unfortunately postponed. So I don't know, but they've got a huge infrastructure, as in the rail. that's pretty awesome in itself. So hopefully one day
it's massive. It's enormous, isn't it? I mean, 130 kilometers of railway. Goodness,
Yeah, I know. Great, isn't it?
But also the railways used by the locals. It stops near to an airport too. So it's that in itself is a cash generator.
Exactly. Okay, well, thank you, Alan, for that. So, Empire Metals, then, Dan. I don't think we've talked about Empire Metals before, and I know very little about them. So,
so speaking of companies doing dual listing, that's actually something that Empire Metals has done this week, today. And with that in mind, I just wanted to talk about them quickly because the company's come onto my radar recently. So Empire has risen around 60% so far this year. It's trading at around 11.5 pence with a market cap of nearly £73 million. But I think the company makes a decent case for why it's still significantly undervalued. And at the heart of this is the quality of its asset. So Empire is developing the largest known titanium discovery in the world, which is the Pitfield project in Western Australia. And Pitfield isn't just large, it's also high grade. The company is currently focused on what it calls a weathered cap at the project, where high purity titanium dioxide minerals are abundant at surface. The area is estimated to contain between 4 to 4.9 billion tons, with a grade range of 4.8 to 5.9% titanium dioxide. And because these grades are so high and so close to surface, Empire, in theory, can produce a titanium product with simple low-cost mining that requires minimal processing before it can sell to end users. And that is very valuable right now. Titanium is an essential and irreplaceable metal in everything from the aerospace and defense sectors to medical and EV applications. But supply globally is dominated, as it is often the case, by China, which, as we know, isn't afraid to let the world know the strength of its hand by way of export restrictions and, more recently, tariffs. So the long and short of it is there's a dearth of titanium to supply globally in alternative jurisdictions at a time when demand is rising. It is, in other words, a critical metal for Western nations globally. And with Pitfield, Empire holds an asset that's very much capable of significantly plugging this gap. So Empire is at a key point at Pitfield's development. It's currently completing a major drilling program to support the development of a mineral resource estimate for that high-grade titanium in the weathered cap I mentioned. This week, it delivered a high-purity titanium dioxide product, assaying at 91.6% titanium dioxide, and it's now collecting metallurgical bulk samples to further advance its marketing to end users and off-takers. And it's also planning a mining study to evaluate the potential for low-cost mining, as well as a pilot plant to further refine processing and optimize project economics. Yet at £72 million, its current valuation is significantly below that of its peers in the titanium space, who are either at a similar stage or a bit further along. So the examples in Empire's presentation include Hyperion X, which had a market cap of $743 million, Sovereign Metals, which was valued at $346 million, and Nordic Mining, which is valued at $245 million. So remember, Empire is developing the largest known titanium discovery in the world with very high grades. So if it's able to deliver on any of those 2025 work programs I just mentioned over the coming months, it stands to drive a significant re-rating in its share price and valuation to the benefit of people who are investing like now or who are already invested. So I think positive news on strategic partnerships, resource definition, the definition of a saleable product, feasibility studies, offtake agreements could really have a positive effect here. And with Empire recently raising £2.5 million, strengthening its board with the addition of a Newmont veteran, and this week adding a listing to the OTCQB in the States, it's in a better position than ever to deliver. So I feel really positive about this stock, and would like to cover them in perhaps a bit more depth in a future episode. And likewise, it'd be great, maybe Mark, if you could speak to them at some point. I'd like to hear more about what they've got to say.
Indeed. Well, it's one to put on the list to try and see if we can get a hold of. I mean, just quickly, Alan, do you have you come across Empire before?
Well, I have, and I was actually we have somebody that looks after our dealing account, and we were actually put into Empire at about, I think it was about 3p, and it's done very well since. So, but I think we sold out halfway up. But I agree with you, Dan. I think this company's got so much further to go. You know, the Pitfield asset is huge. It's highly regarded, and also the management team, I think, have done a great job in just building the story, building the investment proposition. So yeah, it's a well-run company, and yeah, I expect a lot more to come. And as you say, when you look at peer group, like such as Sovereign Metals, and I thought the interview with Sovereign was great this week, by the way, Mark. Really well put together with Frank Eager and Sapan and Charles Archer. It was great. But I think there's a similar value proposition buried in Empire Metals, and the team are just building the story steadily, and we're going to see. I'm sure see plenty more developments as Dan alluded to, partnerships, and likewise to just build on the existing value.
Indeed.
Definitely.
Good. Well, thank you for that. So, Alan, you want to finish us off with Harena, again, a new one.
Yeah, this is a company, and you know, so I'm going to try and lift the mood of doom and gloom surrounding the miners at the moment.
Good.
And happy to say that I spoke to a company last night that's in the process of raising money, which is great. And also, this company has already raised money and it's IPOing on 30 next week. Harena Resources, the EPIC code will be HREE. It will debut on the London main market. It's raising 1.35 million at 3p, and it'll come to market with the approximate market capitalization of about 12.5 million on its admission. And this is essentially an RTO into an existing company, Citius Resources. EPIC code is currently CRES. And the company is buying it's buying a 75% stake in a well advanced rare earths project in Madagascar. It's the Ampasindava rare earths project, which is an ionic clay rare earths deposit. It has a JORC resource estimate already of 606 million tons of rare earth oxides, 22% of which are rare earth magnet metals, including neodymium, praseodymium, dysprosium. That sounds like a headache pill, and terbium. The motto of the company is local first, national second, international third. So it's very much focused on sustainability, preserving the environment. It's obviously a beautiful island, Madagascar. But there's an awful lot of work already been undertaken there. 4,470 test pits have been dug. 277 holes have been drilled. That's over 20,000 meters of drilling. And what the company refers to as the heap leach process, where the rare earths are leached out of the ionic clays, has resulted in a very acceptable mineral yield into the final material. So the company's coming to market. The money's being raised to take the company through a proof of concept phase. And this will finalise project economics and technical viability. But it's important to understand that the company, or the asset, Ampasindava, is an easy to manage, low impact project. The material, or the ore, is literally a couple of meters below the surface. So the rehabilitation of the land is a very straightforward process also. So when the pits have been dug, the soil that's been extracted, the extracted residual material is then washed, is returned, and then it's covered with stockpile extracted topsoil, and also a revegetation program to return the land as it was. And of course, this is very much a key part of mining nowadays. So the board of the company is long established. Joe Belladonna is the managing director, and he's currently doing a few interviews around the area. He was previously chief financial officer at a company called Western Areas. There's Alan Mulligan, who's also a major shareholder in the company. He's executive technical director, as a mining engineer with extensive experience operating mines in Africa. Tim Morrison is chairman, non-executive director and founder of Galena Mining, and a great track record there. And then you've got Stephen Lynn, also a non-exec, who's over 25 years experience as a geologist, and mineral industry executive Philippa Leggett is also a non-exec on the group as well. So yes, coming to market next Thursday with a fanfare, so keep an eye out for it. But rare earths obviously are a hugely important part of life nowadays, and this particular project, I think, is going to play a major role on the world stage as supplies gravitate away from China.
Okay, interesting, Alan. Interesting. How did you come across that opportunity out of interest?
Well, we're working with the team that are managing the company.
Okay.
So we've and this has been on the launch pad for some time, but obviously, market conditions haven't been easy. But everything's now in place. All the boxes have been ticked, and we're ready for liftoff on next Thursday.
Excellent. Okay. Well, thank you very much, Alan, for introducing that. It's always nice to get an idea of what's going down the IPO pipe. Thank you both for your time, and enjoy your weekends. Hope they're good, and we'll speak in a week's time.
Thank you,
Thanks.
Mark. Thank you, Dan.
If you enjoyed this interview, then give us a thumbs up, a like, or a retweet. Subscribe to us on YouTube or follow us on Twitter, and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stopboxmedia.com. Thank you for watching.